Stanford University.
The Dean of Career Services in the tent, if you haven't already, to learn more about the SLS Navigator, right here. It's the new curriculum guide tool for students. We'd love to have your feedback. And so if you can go out to that tent at some point during your visit, that's terrific. I'd like to ask you to please turn off your cell phones or anything else that might make noise during the class. And finally, for those of you who are interested in credit for this class, there is a table set up outside for MCLE credit. It is my pleasure to introduce our speaker today. Howard Pearson is the Development Legal Counsel and the Senior Philanthropic Advisor at Stanford University and a lecturer at the Stanford Law School, where he teaches two classes, Trusts and Estates and Estate Planning. He joined the firm of Robeck, Flecker, and Harrison, where he was an associate and partner in the field of estate planning for 15 years before joining Stanford again in 1995. For many years, Howie was a co-editor of the California Probate Practice with Matthew Bender. Please join me in welcoming Howard Pearson.
Well, thank you. It's pleasure to be here. This is a bigger classroom than I usually lecture in. Trusts and Estates is the old bar class, and it gets anywhere from 25 to 60 students, but it's in a smaller classroom. Estate planning is a smaller class at the law school, or more of a seminar class. I get anywhere from 10 to 25 people in that. So it's great to have a group here. I've been doing this for a few years, and there's always a kind of a wide range of experience. So I'd like to know the audience, who is an attorney who spends most of their time doing estate planning? Okay, 1, 2. So all the tough questions, some other, they're going to answer. And the rest of us will kind of try to learn some of the basics and try to look in the crystal ball to see what's coming up, and a few different things given the current environment that we live in. Let me mention a couple of things before we start. First of all, it's just a great joy for me to be back in the university. I've been here 15 years now, so I don't feel so new, but I have a foot in the general counsel's office, I have a foot in the development office, and I have a foot in the law school, and it's a great combination. Some of my work, and obviously most of my work for the university, has to do with kind of the charitable planning area and endowment issues or trust issues or will issues that involve Stanford. There actually is quite a group in the development office called Planned Giving, 6 or 7 attorneys with a bunch of literature. Some of them are here. Steve Player is here. Carl Wertheimer in the back, attorneys here in the development office. The legal counsel's office at Stanford has about 12 attorneys in it or so, and kind of cover the waterfront and partner a lot with outside firms, probably some that you're involved with. Our topic today is kind of looking at estate planning. I've actually had this topic. Anybody came 5 years ago? I did do this 5 years ago. Do you remember what the topic was then? Just say the same, and yeah, pretty much the same thing. I think I added a word or maybe, but the topic is pretty much the same. And we've really been operating in a very interesting situation for the last many years of not knowing really what the future held. There kept being talk about new legislation, and we haven't had any, but the law keeps changing, notwithstanding, and we're in a very interesting year this year that we haven't had for a long, long time. I think the estate tax was instituted in about 1914, at least the one we have now, this year we don't have an estate tax, so we're in that kind of interesting year. But a couple of other things are different too. One is we've had some fluctuations of wealth in the last few years. I probably don't need to tell you that, but your accounts are down a little bit from the 2008 high. And you can see from this chart what's happened to the Dow Jones since about 2000, or the last 5 years, I think this is. And you can see that if people were in stocks, they lost half their wealth. And that can cause quite an impact on one's plans for children or charity or other loved ones. And so we've got this interesting kind of economic environment. I don't know how you're feeling about the future. Some are cautiously optimistic, others are pretty pessimistic. But we've had a little bit of stability now for the last year, but in terms of estate planning, when we tend to think in terms of 5-year and 10-year increments, if not longer, we're reminded about the volatility of our estates. And they don't just go up and up and up. They can go down, down, down. And that's what we've had there. On the estate and gift tax side, we've been operating since 2001 with a legislative regime that says we're going to have an estate tax that gradually decreases in its impact until the year 2010, when it goes away altogether. And then, because Congress says we didn't have it, or President Bush said we didn't have enough votes back in 2001, we're going to have it all come back again in 2011. And so in 2011, we're going to have the estate tax back as it existed in 2001. So we're going to have a different regime next year than we have this year, and last year was very much different than this year. So this chart shows you a little bit of that. Back in 2000 and 2001, any estate under $675,000 could pass tax-free to their children. And then we have a situation where the exemption for the estate tax, the blue line, continues to increase until it was $3.5 million exemption last year. Now, this year, we have an unlimited exemption. This has an exemption going down to 0. It really should be just the opposite and way up where you can't see it because it's an infinite exemption. There is no estate tax. Next year, the estate tax exemption comes back at $1 million. And so last year, if you died having less than 3.5, you were okay. This year, you can have 10 billion, 100 billion, it's okay. Next year, you have to have less than $1 million to die and leave it to children or other loved ones other than a spouse. We'll talk about that. Another way to look at this is the rates for gift tax and estate tax. So the rates were 55% when this legislative regime came in. There actually was a little blip. You could actually go to the 60% bracket between $10 and $20 million. And it's just gradually gone down until this year when we have an estate tax rate of basically 0. So there's no estate tax this year. And next year we go back to the 55% bracket. Again, with the possibility between $10 and $20 million of a 60% bracket. So that's all kind of interesting. The other thing that's, I think, interesting is kind of on the income tax side. We have a situation where we've had very low income tax rates. The capital gain rate at 15% is as low as it's been for a long, long time. And that's scheduled to go up on January 1. The income tax structure of our tax system impacts what we do on the estate planning area, kind of on the periphery. Not quite as much as the estate tax and gift tax rates, but it's certainly something that you can keep track of and can influence what people do with assets, particularly with appreciated assets, and when they sell and how they sell. Let me go back to this slide and mention one thing that's interesting here, and that's the $1 million gift tax exemption that stays the same. And here, one of the interesting things you'll see about the red line is the gift tax rate at 35%. That's the lowest gift tax rate in 70 years. So what we'll talk about a little bit later is maybe some planning opportunities because the gift tax rate is lower than it's been for 70 years. Let's talk before we kind of go through the basic rules about what might happen in the future. So I think in the early 2000s, middle 2000s, everybody was saying for sure there would be legislation that would kind of do something to make permanent and make more sense than what we have here in terms of the exemptions and the rates. I mean, it really is hard to plan when you don't know when you're going to die, you don't know if there's an estate tax or not, and you don't know how much the exemption is. I mean, it's really hard to plan. People tend not to want to visit their attorney every month to redo their estate plan, and so they want to have some sort of assurance of what goes on, and they really just don't have it. I like to tell an attorney story about what's the oldest profession between an engineer, a lawyer, and a doctor. And I'm going to change it to say instead of a doctor, it's a congressperson or the Congress, congressman or congresswoman, a doctor, and an engineer. And they're talking about which is the oldest profession. And the doctor says it was clearly the medical profession, because if you go back to the very first part of Genesis, it talks about how Eve was created from a rib of Adam. What a great medical procedure that was. It's got to be the medical profession. And the engineer says, well, if you go further back, it says God created, out of chaos, created I the world. So what an engineering feat, taking chaos and making the world. It was clearly the engineer. And the congressman simply says, well, who created the chaos? And that is truly what we have here. Now, you can substitute that in most cases for lawyers, and lawyers make up a good part of Congress, so maybe that's okay. But that's really true. I mean, we really have this kind of chaotic situation. But really, no one thought we would get to 2010 without some sort of legislation. It's a little bit of a commentary on how our system is working these days, that they can't get their act together. There were some pretty hard efforts to try to do that. And basically what happened was the Democrats said we should have an estate tax, and we should have an estate tax with maybe a $3.5 million exemption, and the rate should be 45%. That's kind of where one group is. There's the Republicans, kind of as the other group, that kind of say, we would just as soon get rid of the estate tax altogether, but if we have to have an estate tax, we'd like to have something like a $5 million exemption and a rate of about 35%. And they were unwilling to work out a compromise from that. Now, will we have a compromise in post-November elections? Certainly nothing's going to happen before then. There is a possibility that we'll have some legislation in later November or December. I don't know if I took a vote here. Who thinks there'll be income tax or estate tax legislation in 2010? Okay, there's some. I think there certainly is a possibility. I don't know if it's 50% or 30% or 70%. Somewhere in there it probably is. There's also a very high likelihood that we won't. Let me just, before that, let's get into I want to mention just a couple of the arguments for doing away with the estate tax altogether, and some of the arguments for keeping the estate tax altogether. And when I say estate tax, I do mean the tax that happens at death. The gift tax is pretty well assured that we will continue to have forever, because it is a necessary kind of complement to the income tax system. If we had no gift tax, people would be able to manipulate the income tax system on who owned assets when assets were sold. That would affect the income tax side of things. So we undoubtedly will have a gift tax. In 2001, there were more than 50% of Congress that was willing to do away with the estate tax, but there wasn't 60%. And they needed 60% under the Byrd rule because of the impact on the public fisc to decrease taxes that much took a 60% majority. And they didn't have that. Hence, the system they did is they said, well, we're going to decrease it, we're going to repeal it for 1 year, and everybody, well, not everybody, but those that voted for it, hoped that succeeding Congresses would do away with the estate tax. Now, one of the interesting historical facts of our country is we've actually had the estate tax 4 times in our country's history. Every time it's been acted when? War. It's been to raise money for war. The one in the 1910s was for World War I, and we just never got rid of it after that. Every other time, it was around for a while and then went away. Since then, we've had it. And it affects very few people, generally, depending on what the exemption is, impacts how many, but the number last year, $3.5 million exemption, certainly less than 1% of the population was affected by the estate tax. On the other hand, if you took a poll on how people thought of the estate tax in terms of a fairness tax, it was right at the top as unfair. It's deemed, in a lot of people's mind, to be a double tax. They're subject to income tax during life, and then they would be subject to estate tax at death. Yes?
When you say less than 1%, was it that you mean less than 1% of the estates of people who died were above 3.5 million?
Yes. Yes.
Okay.
Yeah. The double taxation is one argument. The ability, if you plan really well, to maybe avoid the tax or at least minimize the tax is viewed as a problem. The amount of money raised by the tax is relatively small. Some people say it's less than what it takes to fund the IRS. That's not true. It raises somewhere in the order of 30 to 40 billion, again, depending kind of on the exemption. And the IRS budget is less than that. But it's maybe at best 1% of kind of the country's revenues. So there are some reasons that people give not to have it. On the other side, people think that it is a way to kind of equalize opportunity to some extent in the country. It is also viewed as maybe okay because the country provides people the opportunity to make that kind of significant wealth during their lifetime, and therefore it's okay to take some of that back at the time and put it back into a system that hopefully promotes the opportunity for others to do that. On the double taxation, on the larger estates, as a practical matter, in fact, there really is not that much double taxation that occurs because a lot of the wealth that people have are in unrealized gains during their lifetime. And so there's not as much double taxation as you might initially think. So there's some interesting arguments. We're going to see them every 10 or 15 years. They'll be trotted out and people will talk about them. Right now, because of the state of the economy and the need for government for revenues and the fact that we're kind of in a war, we probably, nobody's really talking about the estate tax. Okay, let me go through and let me say, if you have questions, feel free to raise your hand. I reserve the right not to call on you, and I reserve the right to move on in case we need to move on. But I'm happy to take questions throughout. So here's a question.
Just real quick, what do other countries do?
Oh, good point. So what do other countries do? Canada, for example, and this is actually one reason why someday we may not have an estate tax. There are other ways to handle it. Canada, for instance, kind of treats death as the last big sale. And so you kind of have, it's kind of a capital gain recognition event. You get to treat it as a sale of your assets. Or what they do is they have the heirs take over the tax basis of those that have died. And that's actually what Canada does. They don't actually tax you right then. But their heirs receive, like if you had a Microsoft stock that you bought for $10 way back when, and now it's worth, after splits and so on, a huge amount of money, your heirs would take that old basis, and they then would be taxed when they sell it. And we're going to talk about that regime, carryover basis. A lot of countries do have an estate tax or an inheritance tax. An inheritance tax is a tax on who inherited. So if a spouse inherits it, they might be taxed, not taxed at all. If a child receives it, maybe they're taxed at 10 or 20%, and if somebody else receives it who's not related, they get taxed at 50%. So that's an inheritance tax. Question?
Well, what's going to be about, you said you were going to talk about the carryover basis, but
yeah.
So a narrower question is, how does the carryover basis work just in 2010?
Okay, hold that. Let's get to that. That's a great question. Okay, let me go through just some of the basics for those that don't have this on the tip of their tongue. I've obviously assumed that gratuitous transfers are taxable. And so if you make a gift to anyone, you're in the tax system. Now there are a lot of exemptions and exclusions and deductions that then make a lot of transfers not taxable, but you start from the proposition that gratuitous transfers are taxable. And from there you look at what exemptions you have. So the first exemption typically you have is a annual exclusion amount. You can give $13,000 this year to anybody you want and to as many people as you want. So I can give $13,000 to each of you, and that's outside the tax system. It doesn't use anything else. I don't even have to file a tax return. I can give you a birthday present or a Christmas present, or I can give $13,000 to each of my children. So I have 4 children, so that's $13,000 to each of them, and my wife can do the same thing, and I can do it this month in October, and then I can do it again in January. And believe me, that's going to deplete my estate really fast. But Bill Gates, that's not going to enter in too much to his estate. But for most of us, that's a useful tool to have. There also is kind of an expanded annual exclusion, which is you can make gifts to anyone, again, usually it's children or grandchildren, of educational expenses. And as long as the check is made out directly to the education provider, there's no tax on that. It's like the $13,000 exclusion. So you parents or grandparents who are paying tuition for grandchildren, make out the check directly to the education provider, and that's a nice kind of gift probably to your children as much as to your grandchildren, because they would be covering the cost if you're a grandparent, and is a nice way to transfer assets on a tax-efficient basis. You can also pay for medical expenses. So if you're taking care of an aunt or a parent or grandparent, as long as you pay directly to the medical provider, that's outside the tax system. Then beyond that, there is the annual or the lifetime exclusion amount. Let me put another chart up here that's maybe a little easier to, or has the numbers down. So that's page 9. So you have a gift tax exemption of $1 million. That means I can give $1 million to my children or other people, not per child, but in the aggregate, And I keep track of it year upon year, so it's a building block system. If I give $100,000 to them this year, over and above my $13,000 in annual exclusion, then I have $900,000 to give in the future. Once I cross the $1 million threshold, then I have to start writing checks to the government. Okay? I have to start writing checks to the government. This rate, and the rate is 35% this year for that. Now, at death, I have this year, an unlimited amount at death. So if you were trying to time your death, I don't necessarily suggest this, but if you're trying to, this is the year. You know, this is the year there's no tax. Last year you had $3.5 million. Next year you have $1 million. What's happened is, going back to the chart, for many, many years, since the 1980s at least, early 80s, the gift and, well, actually 1976, the gift and estate tax exemption amounted to the same thing. It was a completely unified system. In 2003, they started to diverge, the gift tax and estate tax system, in terms of the exemption amount. Next year, they get to come back together. It makes planning a little easier, but you have a much lower exemption. So let's take a minute here and say, the one thing about the future, when I keep saying $1 million, we need to realize that that could be changed. It could be changed this year by Congress. It could be changed next year by Congress. And Congress has no hesitancy to do retroactive legislation. So come January, you may think you have $1 million exemption, but come September, you actually may have a $3.5 million exemption. You really won't know. And it's actually possible that we'll get legislation in November or December of this year that's retroactive to January 1 of this year, so that people who died in February thinking that there was no estate tax, in fact, there may be an estate tax. And that probably is constitutional for you constitutional law scholars. There will be a challenge to it, and it's possible that it will be viewed as some sort of taking without due process, but most likely not. There's enough cases on the matter in the past, nothing as, say, egregious as this, but that would indicate that retroactive legislation like this is probably okay. So we're really in this kind of limbo land. I keep talking about what the law will be on January 1. I personally think that it's probably 50-50 if Democrats and GOP will get together and make legislation. I think there's a 50% chance that on January 1 we have just what we have now. And we'll have $1 million exemption and we'll have tax rates of 55%. Okay, that's the applicable exclusion amount. The two very big deductions that you get when you die or when you make gifts during lifetime. One is you can give as much as you want to a spouse. No tax. Two, you can give as much as you want to charity, and there's no tax. Some people call the estate tax a voluntary tax because you actually can avoid the tax. That's different than your income tax. The income tax maxes your deductions. It's very difficult to have income that gets completely shielded by gifts. There's limitations on charitable gifts, 50% of adjusted gross income. But in the estate and gift tax area, you can have anything you give to charity is deductible, 100%. So that's kind of the main deductions. Now, adjusted tax basis on debt. Right now, we're in a situation that hasn't occurred since 1976. And then in 1976, it never was implemented. And that's a system called carryover basis. So if I were to die and I was smart enough to buy Google stock for $100 back when it went public, and now it's worth, what, 500, let's say. If I were to die under every year but this year, my heirs could sell that $500 share of Google stock, and they would have to pay no capital gain. That's because my $100 of tax basis, cost basis in that stock gets a step up to the fair market value at the date of death. It also would receive a step down if the stock had gone down in value. But it gets adjusted to the fair market value. Well, this year, they did away with that. So the idea was to do away with the estate tax, but to substitute in this carryover basis so that when my heirs would sell that Google stock, they would have to pay capital gain on it. Now, this year, there is $1.3 million that you can allocate to a decedent's executor or trustee can allocate to assets and get a step up in basis up to $1.3 million. They can pick and choose assets in the decedent's estate to do that. There's no form on which to do that. The IRS thought Congress was going to do something. They didn't want to waste resources, so they didn't really worry about the fact we had no estate tax and we had carryover basis until about July of this year. And then they started working on some forms. So we haven't seen the forms yet. We probably won't see them for a while. They're not due until April at the earliest of 2011, so we'll probably, hopefully see them by March. And so that's where we are, kind of on the 1.3 million allocation of basis. In addition to that, there is an extra $3 million of allocation of basis to assets passing to a spouse. Okay? So assets passing to a spouse really have that $3 million plus the 1.3 million that can be allocated. So that's kind of where we are on the carryover basis. Now that's all going to stop on January 1, absent legislation. And on January 1, we're going to go back to the system of a step up in basis. The real difficulty with the carryover basis is no one knows what basis people have in old assets that were acquired some years ago. And you can't just go ask the decedent about it either, because the decedent is dead. And so somebody's got records and so on. They're starting to impose some record keeping on the brokerage houses and so on. And so maybe sometime in the future, we really will have carryover basis. But most people recognize it's really impractical to impose. So it's likely that we won't have that for a while. I mentioned 1976. That's the time I was in law school and then graduated in 1979. They actually had carryover basis there for a few years. Some of you may remember. And then every year they would postpone it. And then finally they repealed it altogether in 1979. Yes, question?
You said some other countries have this carryover basis structure. How do they deal with the lack of documentation and inability to know?
Yeah, I'm not sure how Canada does. I'll tell you how the United States was going to deal with it. If you couldn't prove what the basis was, you had a zero basis. So that would be kind of tough. But yeah, we're going to do that. Last point here is that the state may have an estate tax. So in California, for instance, we had the estate tax for a long time. It usually amounted to equaling the credit for state death taxes paid on your federal return. So if I paid $1 to Sacramento, it would act as a dollar for dollar credit against any tax I had to pay to Washington, D.C. And so while there was a state tax, it didn't increase any decedent's estate tax. It just allocated it differently. Well, Congress is smart enough to realize that's a loophole for Washington dollars, so they repealed the state death tax credit, and that in California meant there was no estate tax, but it didn't decrease the estate tax that had to be paid. It just all went to Washington. Now, on January 1, the state death tax credit is going to come back. And so California will have an estate tax equal to the amount of the credit that is allowed on a federal estate tax return. So that's another little quirk. There's all these levels of kind of details when we get talk about chaos again. So we're back to that. Let's see, it was a question, yes?
Yes, absent legislation on January 1st, okay, a spouse, there is no estate tax on what's left with spouse. But then do they get the step-up basis or they get the carryover basis?
Great question. So on January 1, absent legislation, everybody gets a step-up, whether it goes to a spouse or a child or significant other, whoever gets it. There'll be a step-up in basis on all assets at death on January 1 going forward.
Which means that the basis is the basis on the day
Of death.
So the best thing to do is to give everything to your spouse.
Yes, and if you want to have serials, if a surviving spouse remarries, you could go on for a long time. It doesn't really happen that way, but yeah, you certainly, and that we'll look at a quick example of how giving your spouse.
Related question. I seem to recall that many years ago, there was a rule that in community property to obtain a step-up basis on both halves of the community property. Has that been changed over the years?
Nope. In fact, my last bullet point on page 7, my clicker here, is just to remind us of that. In estate planning, title to assets is really important. And one of the reasons it's really important in community property estates is just for that reason. In community property estates, both the decedent's half of community property and the surviving spouse's half of community property get a step up in basis. States that aren't community property, or if in California you held assets as joint tenants and without other agreements and so on, only the decedent's half would get a step up. The surviving spouse's half would stay at the original cost basis. So there's some planning that goes around basis adjustment and so on. It's usually kind of a little bit on the periphery. It's not as important as the estate tax and the gift tax rates, but there is some planning. But title to assets is also important because it dictates where assets go. So retirement plan designations, life insurance designations, whether assets are titled joint tenancy or community property, whether they're titled in a trust or not, all of that can have a big difference on where the assets actually go. Okay? Question?
Is it mechanically, is the amount of the asset valued at date of death or 1 year later?
Assets are valued at the date of death for purposes of step-up in basis and for purposes of determining the value of the estate.
So that 1 year later business is no longer in force?
There never was a 1 year. There is a 6-month alternate valuation date.
Oh, okay.
If assets go down in value, you can choose a 6-month alternate valuation date. Yeah. And that, again, will be back with us next year. Let me mention, I have annual gifts. We've already talked about that. Combining the applicable exemption with the marital deduction, very common when the first spouse dies to put the first spouse's exemption amount into a trust for the surviving spouse, and then that exemption will be kind of preserved, so when the surviving spouse dies, that amount won't be taxed, and the surviving spouse has his or her exemption amount as well. So that's the way you maximize your exemption amount. Gifts during lifetime, in addition, over and above the $13,000 annual exclusion, is clearly something to think about this year. And the reason I say that is because of the all-time low gift tax rate. So you obviously can give up to $1 million, and there's no tax on that, at least not when you make the gift. Later on, when you die, your estate is added on to that, and there could be, pushes you up into a bracket or into a tax situation. For people with a lot of wealth, towards the end of this year, many people are planning to make significant gifts to children or grandchildren in order to take advantage of the 35% bracket. Now, psychologically, it's very difficult for people to enter into a tax arrangement, such as gifts to family members, that actually makes you write a check when you could defer that until you die. So there is a kind of a tug there. But for those that feel like their children are responsible or their grandchildren are responsible, there are people who are thinking about making significant gifts. When they pay that 35% tax, that tax amount that they pay to the government is now outside of their estate also. So it's depleted their estate. If they wait until they die, one of the disadvantages of estate tax is the amount of tax you pay the government is actually subject to tax in your estate, the way it works out. And you don't get a deduction for that amount that you pay. Whereas if you pay it as a gift tax, it gets it out of your estate. And so economically, you're better off making a gift tax. Now, typically, when the rates are about the same, people have been unwilling to pay the gift tax. Some people do, but majority of people don't. And obviously, we're talking about larger estates there. One thing about gifts to grandchildren, there is something called a generation skipping tax. If you make a gift to grandchildren, in addition to the gift tax or the estate tax, whether it's a gift during death or at death or during lifetime, there's another tax called a generation skipping tax. And the only thing I'll mention about the generation skipping tax is if you make a gift to a grandchild that is in trust for the grandchild this year we have no generation skipping tax. It's like the estate tax is gone. But it may come back. And if you put the money into a trust, it will come back, commentators say, when the distributions from the trust occur. So the bottom line is, if you're making a gift to a grandchild, it's got to be an outright gift to a grandchild. If you're trying to kind of beat the system, so to speak. Okay? And that's all we'll say about generations. Yep.
I don't understand why, if you give something, and say you've gone past the $1 million.
Yep.
I don't understand why, when it comes to the time to die, you made this gift, maybe 5 years, maybe 7 years, maybe only 2 years before you die. Why does that gift go back into your estate? I don't understand it. That does not seem fair.
It goes back into your estate only to determine how much of estate tax you have to pay. You don't have to repay tax on the gift. So you get a credit for all the gift tax you paid on that gift. It just is to make it more equal for someone who makes a gift during lifetime or at death. And I can explain that better after if you want to come up. But it's kind of a building block approach. Yes?
The $1 million gift lifetime max, is that $13,000 a year go towards the $1 million?
No, in addition to...
Oh, it's the $1 million in addition?
Yes.
So in other words, if you give $13,000 a year gifts to 73 different people, that does not go to the $1 million lifetime exclusion.
If you give $13,000
per year to unlimited numbers of people, that doesn't go to the $1 million.
Correct.
Okay, got it.
Okay, if you, we're going to, I think we've actually covered most of this. Gratuitous transfers, gift tax rate at historic low, but it'll increase 2011, annual exclusion, applicable exclusion, unlimited marital deduction, unlimited charitable. Generation skipping I just covered. State death tax credit is restored in 2011. Carryover basis we talked about. And IRA and retirement plans. One opportunity that you have this year that you probably read about from your brokerage account or something is you do have the opportunity to take money out of your IRA this year. You have to recognize income on that and then move it over into a Roth IRA. And remember, the benefit of Roth IRAs are that you take money out and you aren't subject to income tax, so the appreciation that will occur. If you look at the numbers, and you really have to look at the numbers, the game is if you're going to live a long time and do pretty well with your investments in the Roth IRA, you're probably okay to do that, otherwise not. there's a lot of stuff you can go online and look at that. It doesn't enter in too much into the estate planning world. Yes?
Well, it's still part of your estate, right?
Oh, yes.
What's in the Roth?
Yes, the Roth is going to be. One thing about retirement plans that I mentioned later is, let me just mention that since we're going to run out of time here, and I did want to mention this. The retirement plans are an interesting asset. When someone dies, they are subject to both estate tax and income tax. So they're not a very good asset to leave to family members because they have that double tax. Now there's a little bit of a credit that works in there, but there is a double tax. If you're leaving anything to charity from your estate, the very best asset to leave is a retirement. So that's the planning opportunity for retirement plans, is to have that. So if you're leaving $50,000 to your local church or the YMCA or Stanford, have it come out of your IRA, not out of your estate, out of your will or trust. Let's see, let me go back here. Talk about kind of what you want to do in this interesting environment. One is most people don't have to change their documents. As a practical matter, most people won't change their documents because we're too uncertain. They'll wait to see what happens. But it really is appropriate to review your objectives. And here is the big problem that can emerge. Most estate plans that are written with taxes in mind have a formula. They describe somehow the marital gift or the amount that goes into the exemption trust, the bypass trust, as a formula. And that formula is always tied to how much the exemption is, or how much can be passed tax-free, and the rules are just different this year than they were last year, or that they'll be next year. We don't have an estate tax. We don't have an exemption. So any formula that refers to that is subject to ambiguity, misinterpretation, unclarity of whatever you want to say. Some states have passed legislation to try to define it appropriately, but it would be better to have, and if you've done your estate plan the last couple of years, you're a good estate planner, would have kind of had if this, then that, and then an alternative phrase, if you die in 2011, or if you die when there is an exemption, then this will happen, and they'll have taken care of it. So that's the one thing about reviewing your estate plan. The tax changes will change. Estate plans have a limited life. We knew that before, but it's more limited now. I mentioned there's a reluctance to use techniques that incur gift tax. That is true because there was a potential of no estate tax. It's also true because people don't like to write checks to the government before they have to. This year, in big estates, as I mentioned, with 35% bracket, it is possible that more people will actually incur a gift tax. Review retirement plan designations. There are gifts that don't have gift tax. We've got your exemptions and exclusions we've talked about. One of the big things that you can do is try to minimize the valuations of assets. Putting assets in partnerships or limited liability companies is a big deal to try to get discounts on assets. If you put real property in stocks and bonds in a limited partnership, and then you give limited partnerships away, you have to kind of be careful how you do it. But you can take up to 30, 40% discount from the underlying value of the assets. So you can use, kind of maximize your exemptions and exclusions. The other thing that we have that's very interesting right now is a very low discount rate for valuing streams of income. And there are certain estate planning techniques that take advantage of that. So you can loan money to a child for 9 years at 1.7% this month, 1.73 or something. and there is no gift involved. And hopefully the child might be able to invest that money that's loaned and make more than 1.73. And whatever is above that will in effect be a gift to them, but they don't have to recognize any tax on it. There are also some techniques, grantor retained annuity trust, charitable lead annuity trust, that are very advantageous. Right now, we have for those types of vehicles a 2% discount rate on the stream of income. And what that means is as long as the investments in those trusts do better than 2%, the remainder beneficiary, typically children, will receive assets at the end of the trust term tax-free. That is transfer tax-free. No gift tax, no estate tax. And so if you think that a trustee can invest better than 2%, say over the next, some grants are 2-year grants, charitable lead trusts tend to be 10 or 15 or 20 years. Anyway, you can beat that. There's a lot of planning that can go around it. So we have this low interest. Here's a chart on the low. 2% is a historical low. You can see what it used to be. It was 11.6 21 years ago. The average rate is about 6.5%. We don't have time for this. Yeah?
Before you go any further, the capital community analysis is a customary flat, and that's pretty exciting at 2%, 75 link. But would you really recommend something like that in economic reality today?
As I say, it's got to be somebody that thinks that they can invest better than that. So I don't know, I was just at a conference where someone actually did some spreads, and they looked at the historical tax discount rates, applicable federal rate they call it, compared to what the economy did. And sometimes you lose and sometimes you don't. I mean, it really is looking in the crystal ball. It's difficult for people to do it, but you certainly didn't want to set one up in 2008, right? I mean, you're a lot better setting up one now than you were in 2008. It's just a little more, the cycle is a little harder. Sophisticated estate planning often combines different techniques. We don't have time to talk about these, but there's charitable remainder trust, which is a great way to sell assets without incurring a capital gain right then. It's a great way to benefit charity. You get an income tax deduction, and a lot of good things happen if you're charitably minded. The problem is your children lose out. They don't get the assets in the end. So then maybe you buy some life insurance with the income stream that you get in an irrevocable life insurance trust, and that will replace what goes to charity at the end of the trust. And it's a great way to combine two techniques to get assets to children, to sell assets without incurring tax, and to benefit charity. And that's really what sophisticated estate planning is about, is combining techniques in ways that meet people's objectives. We've got 6 minutes left. I want to provide some time for questions of things we haven't covered or things we have covered. So let me stop there and ask for questions. What haven't we covered? Yeah?
What about gifts of real property that are made to children? I've heard some people saying, look, I want to get out of the gifts tax by selling it to my kids for some like ridiculously low money, $10 for a $5 million estate.
So
what is that about?
If you sell assets to children for fair market value, there's no gift involved. If you sell assets for less than fair market value, then there is a gift. It's part sale and part gift, called a bargain sale. And you would have to file a gift tax return for the amount of the gift. You've got to get it appraised, and so you would be part gift, part sale. The interesting thing you can do with selling an asset is you could sell it for $10, well, 10, maybe 5% down, some kind of down amount, and then the rest on a promissory note. But because interest rates are so low, you can make that promissory note at a very low interest. As I say, for 9 years, it would be at 1.73%. If it's over 9 years, it's a long-term rate. They change these rates every month. I think it's that's around 3.5, or 3.3 maybe. And so that would be, so that's what you can do with sales.
And the real property of $13,000 a year, I mean, $30,000 a year, that also monthly real property?
Oh, sure. Stocks, bonds, cash, real property. Cash is the best thing to give to your children because they don't have any built-in gain with it. So cash is the best thing to give. But sometimes you give other things. You give a slice of a piece of real property. Say 10% of $1 million piece of real property. How much is that worth? It's not, well, it's worth $100,000 to the child, but the valuation is what a willing buyer will pay a willing seller. Well, what would a willing buyer pay for 10% of an undivided piece of real property? Not $100,000. Maybe 70, 75, I don't know, something. Okay, other questions? Yes.
For observations, please, there's been a lot of commentary about the thrust of the budget and the long-term impact it will have on tax rates in government, state, and gift.
So, impact of our deficit, basically, on future tax rates. Well, we're seeing that now. We've got part of people say keep the rates low because it'll generate business and that'll give us more taxes in the long run, and you've got other people saying you've got to raise taxes. You know, at some point, they're going to raise taxes. Whether it's local taxes, state taxes. If you added up all the taxes you have, I think you probably are finding you're paying more tax than you did when the income tax rates were bigger 40 years ago. Because there's a lot of other taxes that we pay that tend to creep up. So, I don't know. I'm not the expert on that. You have to go over to the Stanford Institute on Economic Policy and Research for that or something. But your guess is going to be as good as mine.
You mentioned that the gift of up to $13,000 a year ultimately will be put back in the estate for estate tax?
Not 13,000.
So
the million. The million, not the 13,000. Yeah. Good clarification. Yes?
What about things like property, meaning antiques, furniture, values like that? Are there legal implications to that?
So yeah, very good question. So when you die, your tangible personal property, that fishing rod, lawnmower, Picasso on the wall, all of those things are included in the decedent's estate. They need to be valued. They are reportable on the estate tax return. Now, most furniture and furnishings are worth very little. If you go to try to sell them at a garage sale, you're not going to get very much. The valuable antiques and artwork have to be appraised, and they would, whatever fair market value is.
But to give those, for instance, to a family member before death,
You're supposed to report that as a gift and get an appraisal and have a fair market value. Our system is, our tax system is built on the people honestly reporting with all the reporting that employers and so on have to do. But basically, we have a voluntary tax system. That's where it starts. Question?
Yes, so loaning the money to a child at 1.7%, that's for 9 years, and does that...
Between 3 and 9 years.
And is that included in the $1 million exemption?
No.
That's outside of that?
That's a fair market transaction between
the
child and
piece of paper saying, I hereby owe you money?
Yeah, you'd want to document it appropriately. Make it like a business deal. And those rates just define that if you did it at 0 interest, then it would be a gift. Other question?
Yeah, what happens if you die before the 9 years is up? Because I did, in fact, I left my financial 50% just for the reasons you said.
Oh,
Okay.
good.
Yeah, but supposing I die.
Then the promissory note would be included in your estate. And depending on the terms of the note, I presume the note would just carry on, and it would be an asset of your estate, and they would continue to pay the 1.73%. And if the note goes to them, then it extinguishes itself. They basically get it as an inheritance. Yep. All right.
But it's not included in these. Well, I guess it is.
Well, the promissory note is. The question is, what's the value of the promissory note? That's the asset. Okay, we're out of time. I hope you have a great weekend. Keep the rain away.
For more, please visit us at stanford.edu.